Standard Chartered Bank Chief Economist Gerard Lyons attended the IMF summit and joins us now. Gerard, what sort of concrete things, if anything? We just heard Scott there saying he couldn't take away anything positive from those meetings. The markets took some comfort during the day, and then they've fallen back a little bit. So what did you make of what came out of it?
Well, I think the best way to view it is work in progress. There was a lot of talk, but naturally the markets want to see some actions. What seems to have come out of this weekend is a lot of pressure has been put on the Europeans. That pressure has been put on the Europeans, largely led by the IMF, but behind the scenes the Americans and the Asians in particular are really furious in some respects. They're determined for the Europeans to take firmer action. So the ball is very much back in the Europeans' court, but from the European perspective, there's not the sense of urgency maybe that there should be. The Europeans came to the IMF meetings at the end of last week very much talking about what was unveiled in the summer, the need to implement that. And while Madame Lagarde on Friday was saying implementation is the key word, the reality for the markets is show us some action, don't tell us just be patient. So I think things are happening, and now we've moved from anything really concrete coming out immediately after this IMF as the markets hoped, with the attention now very much switching to the Cannes summit, which is in 6 weeks' time.
Of course, Gerard, the biggest problems remains the banks. By what methods can the banks be recapitalised, and just how much is it going to cost, and how urgent is it?
Yeah, well, urgent is it's immediately urgent. Yes, so you can't be any more urgent than you would want. But in terms of what needs to be done, the Greek finance minister yesterday was saying you can't blame Greece for this problem. He was saying in a speech that the Greek debt is only 3% of the outstanding debt in Europe, and he was saying very much that Portugal, Ireland and Greece are small in the scheme of things. And in some respects he's right. I think what the key issue here is not so much Greece. I think the debate has changed over the last few days as to limiting the contagion and whether the euro can survive in its present form. That's the sense of urgency I think that really needs to be conveyed to the European leaders. So in answer to your question, what really needs to be done is not just about Greece, it's about putting a sufficient firewall in place. Now, the firewall, in my view, has to be big enough not only to handle any potential problem from the likes of Italy and Spain, but so big that the markets think that the firewall, or the war chest, shall we say, doesn't have to be used. Hence, over the last few days, the figures 2 to 3 trillion euros have been bandied around. Now, that amount of money is huge. It seems that from the European side, the European leaders don't really want to add any new money. The desire is to leverage up the existing facility, primarily with the European Central Bank playing the lead role. And then maybe on the back of that, the IMF providing some additional assistance, very much taking on board any money from the Americans and in particular from the Asians.
We live in very interesting times, don't we? Gerard Lyons, Standard Chartered Bank Chief Economist, really great to talk to you live from Washington today.